Hello everyone and welcome to another video of this course. In this lesson, we will be learning about cost basis in oil and gas accounting. And under that, we'll be looking at exploration and acquisition costs, components of exploration and acquisition costs, dry hole accounting, accounting implications of dry hole accounting. So let's start with cost basis in oil and gas accounting. Oil and gas accounting can be very complex, especially when it comes to determining the cost basis. The multitude of variables and regulatory requirements can make this process daunting for even very experienced professionals. In this module, we will delve into the intricacies of cost basis, including acquisition costs, exploration costs, and development costs, and how these elements impact financial reporting and tax obligations, because having an understanding of effectively managing these costs can ensure compliance, optimize tax strategies, and ultimately improve financial performance. So let us start with acquisition costs. Acquisition costs are the initial expenses incurred to obtain the right to explore, drill, and produce oil and gas. These costs lay the groundwork for any oil and gas project as they secure the necessary permissions and access to potential reserves. Without acquiring these rights, companies cannot proceed to the exploration or development stages. Properly managing and recording acquisition costs is crucial for the accurate financial reporting and strategic planning. The main components of acquisition costs include lease payment. And what are lease payments? Payments made to landowners for the right to explore and extract oil and gas. These payments secure the essential land access needed to initiate exploration. Properly accounting for lease payments is crucial to ensure accurate financial reporting. Another component is bonus payment. Upfront payments made to secure leases. These one-time payments can be significant, impacting the overall budget for the project. Accurately capitalizing bonus payments helps in managing financial expectations and tax obligations. The third component is brokerage fees. And these are fees paid to brokers who facilitate the acquisition of leases. Brokerage fees can vary widely based on the complexity and scale of the lease acquisition. Ensuring these costs are properly recorded ensures transparency and accurate cost allocation. The fourth component is the examination costs. Expenses related to ensuring clear title to the lease. This involves legal and administrative work to confirm that the leasing rights are valid and unencumbered. Properly documenting these costs helps prevent legal disputes and ensures compliance. Now we'll be looking at exploration costs. Exploration expenses encompass the costs associated with identifying and assessing potential oil and gas reserves. These expenses are often substantial, reflecting the high-risk nature of exploring activities. Successful exploration can lead to significant financial rewards, but it requires extensive investment in geological surveys, drilling, and analysis. Accurately capturing this cost is essential for understanding the financial health and potential of a project. So these are the key components of exploration expenses. They include geological and geophysical costs, drilling costs, dry hole costs, and seismic survey costs. Now let's look at each of them one by one. Geological and geophysical costs. These are expenses for surveys and studies to identify potential drilling sites. These costs are crucial for understanding the geological landscape and minimizing drilling risks. Proper capitalization of these expenses ensures that they are reflected accurately in financial statements. Another component is drilling costs. This includes cost of drilling exploratory wells to determine the presence of oil and gas. Drilling costs can escalate quickly, especially in challenging terrains. Accurately tracking these costs is essential for both financial reporting and future budgeting. Now, the third component is dry hole costs. Expenses incurred from wells that do not find commercially viable qualities of oil and gas. These costs are part and parcel of the exploration phase, representing the inherent risk of oil and gas exploration. Proper accounting for dry hole cost is necessary to present a realistic financial picture. And then we have the fourth component, which is the seismic survey cost. This involves using seismic waves to map underground formations. Seismic surveys are a critical part of exploration, providing valuable data that can guide drilling decisions. Properly documenting this cost ensures a comprehensive understanding of exploration expenditure. Now, let's look at dry hole accounting. In oil and gas accounting, a dry hole refers to a well that, after being drilled, fails to produce oil or gas in commercially viable quantities. Under the successful efforts method, dry hole costs are expensed in the year they are incurred. Conversely, under the full cost method, dry hole costs are capitalized and included in the overall cost of the reserves to be amortized over time. A dry hole is a well that, despite being drilled, does not yield enough hydrocarbons, which are oil and gas, to be commercially productive. Now, let us look at dry hole accounting under the successful efforts method and full cost method. Under the successful efforts method, this method, also known as the cost method, requires that only costs associated with the successful exploration and development efforts be capitalized. That means treated as an asset. Costs associated with unsuccessful efforts like drilling a dry hole are expensed immediately as a loss, meaning that they are deducted from the current period's income. Under the full cost method, this method capitalizes all costs related to finding and developing oil and gas reserves, including costs from dry holes. These costs are then amortized over the productive life of the reserves. Advocates of this method argue that dry holes are necessary costs of finding productive wells and should be capitalized. Now, what are the accounting implications of this? The choice between the two methods can significantly impact a company's financial statement, particularly its net income and reported cash flow. Under the successful efforts method, dry holes will lead to lower short-term net income as they are expensed immediately. But under the full cost method, while dry holes would initially not impact net income, they would eventually be amortized, affecting the accounting statement. We will stop here for now, and in the next lesson, we will be learning about development and production costs.